52-week low. That's a statement that you love to hear as a value dividend investor. At times, it can present opportunities to buy great companies at great prices. In this video, we're going to be analyzing 3 dividend growth companies that are right at a 52-week low. If you'd like to be able to download the spreadsheet using this video to analyze the stocks, then you can head over to my Patreon page at the link in the description. And the first dividend stock at a 52-week low that we're going to be looking at is Domino's Pizza, stock ticker DPZ, currently trading at $330 per share. Now, this is kind of a unique stock because if you look at their 10-year chart, you can see they provided phenomenal returns to their shareholders, over 775% during that time. Now, if you look at them year to date, down about 40%. So that's a pretty massive amount. Now, if we jump into the income statement and look at their revenues year over year, you can see for the past 10 years, they've had growing revenues. That's pretty rare for any type of company. But let's go ahead and jump into my stock valuation spreadsheet to see if we can find the intrinsic value of this company. On this spreadsheet, we have 4 different valuation models. We have Graham's valuation, a discounted cash flow model, a multiples valuation, and a dividend discount model. So let's go ahead and jump back over to our stock screener. What we'll do is we'll come up here and plug in the stock ticker for Domino's Pizza and hit enter, and you can see all of this data will automatically load in. Now again, we're looking at a 2,500 and day change chart, so you can see the huge run up and then the huge decline. Let's go ahead and zoom in a little bit more and look at the past 365 days. You can see there's a little bit of a bounce back just a few months ago, but we are back at their 52-week low. Coming over here and look at the dividend data, we can see they're paying out $4.40 per share, which gives them a dividend yield of right at 1.33%. So yes, that is a little bit of a lower dividend yield, but we'll look at their dividend growth just a little bit later in the video. Now looking at the payout ratio, they have a really nice safe payout ratio at 31%, giving them plenty of room to continue to grow as a business and to grow their dividends. Now the 20, 50, and 200-day moving averages are all down, obviously, since they're at a 52-week low. If we come over here and look at the analyst target price, we can see it's $426 per share. Their beta is sitting at 0.61, so there's not typically a lot of volatility, but something that's really interesting about this company is we come over here and look at this institutional ownership, 96.4%. That is extremely high. That's about as high as I've seen it. So there's obviously a lot of confidence in this company long term. But let's go ahead and jump into our first valuation, which is going to be Graham's valuation. And this is a valuation model invented by Benjamin Graham, one of Warren Buffett's mentors. And here's the formula he lays out for us to calculate intrinsic value. And the key things that drive the intrinsic value according to this formula are going to be our earnings per share, our growth rate projection, and the current yield of AAA corporate bonds. So you can see we have Domino's Pizza's earnings per share listed right here. Now the growth rate projections for this company are still fairly high at 11.15, so I'm going to stick with that. But why the current yield of AAA corporate bonds is as high as it's been all year, which is going to lead to a lower intrinsic value. It's currently sitting at 4.65. Once we plug all of that in, we come to an intrinsic value of $224 per share. Now keep in mind, earlier this year, this was as low as 2.8. So let's give it an average. Let's say we plug in 3.5 here. That would give it an intrinsic value of $298, quite a bit higher. But let's go ahead and plug back in what it is right now, 4.65, and we can see intrinsic value of $224. Now let's go ahead and move on to our next valuation, one of the most popular, the discounted cash flow model. And in order to perform this model, we need to project a growth rate to the future free cash flows of the company. So in order to do so, I plugged in the historical free cash flow for this company, and now we can see the year-over-year growth rates for them. They've had an average growth rate over the past 4 or 5 years of 19.6%, so that is a really great growth rate for their free cash flow. Now moving forward, I'm projecting a growth rate of about 11%, so that's still pretty high, but I don't think it'll stay as high as 20% moving forward. It'll probably come back down closer to that range. So I use that growth rate to project the future free cash flows and the terminal value, which is the sum of all the future free cash flows past the year 2030. We then take the present value of those future free cash flows and add them together here, add the company's cash, subtract out their total debt to find their equity value, divide by our shares outstanding, and we come to a discounted cash flow price per share of $409.20, a lot higher than the current trading price. Let's go ahead and move on to our next one, the multiples valuation. And essentially the idea behind our multiples valuation is we're using a price to earnings multiple to see how the market is valuing companies that are similar in structure. So we're taking companies like McDonald's, Yum Brands, Starbucks, and Papa John's. We're taking their stock price, dividing by the earnings per share to get our price to earnings multiple. Then we take the average of these price to earnings multiples and we multiply it by Domino's Pizza's earnings per share to find they have an intrinsic value of about $343 per share. Now keep in mind, we will get a lower valuation using this valuation model currently, since the market as a whole is currently down, leading to lower price to earnings multiples for all of these companies. Let's go ahead and look at our last valuation, the dividend discount model. And this is where things get really interesting for Domino's. And as a value dividend investor, this is always something that I really want to pay close attention to, because this is going to value a company based on how much they pay out in dividends and how much that dividend is growing. Now, if we jump back over to our stock screen, you'll remember they do have a low starting dividend yield, so that's going to hurt their valuation here a little bit. But if we jump back over, you can see I plugged in the quarterly dividend payouts right here, so we can see their yearly dividend payouts, and this allows us to see the year-over-year dividend growth rates, which we have 18%, 20%, 20.5%, and 17%. So that is absolutely phenomenal dividend growth from this company. Year over year, that's an average growth rate of right at 19%. That is pretty unbelievable. So moving forward, I'm applying a growth rate of 8% to the dividends for this company. Obviously not as high as that average growth rate of 19%. That will likely come down long term, but an 8% dividend growth rate is still extremely strong long term for this company. Now, after applying a discount rate of 9%, we come to a dividend discount model price per share of $475. So when we jump over to our output tab, we can see all four of our valuations: 224, 343, discounted cash flow at 409, and dividend discount model at 475. And when we average all four of these together, we come to an intrinsic value of $363 per share. Now, obviously, what's driving down this valuation a little bit is going to be Graham's valuation and multiples valuation. Due to the current yield of AAA corporate bonds being so high and the overall market currently being down, will drive the multiples valuation down slightly. But overall, I love it from a discounted cash flow perspective and a dividend discount model perspective. Now, the current trading price for this company is $330 per share. Intrinsic value, $363. But as a value dividend investor, we always apply a margin of safety. So let's say I apply a 10% margin of safety. Based upon that, our acceptable buy price for the company would be $326 per share, meaning it's not quite at our acceptable buy price, but it is getting very, very close. Let's go ahead and move on to our next company. The next dividend stock that we're going to be looking at is Home Depot, stock ticker HD, currently trading at $270.94 per share. Now, year to date, they're down about 33.7%, and we can see, like Domino's, back in the month of June, they were trading right at their 52-week low, had a little bit of a run up, and now are back down to that all-time low. Now, let's go ahead and jump into our stock valuation spreadsheet. We'll come up here and plug in the stock ticker for Home Depot, and all of this data will load in. Coming over here and looking at the dividend data, we can see they're paying out $7.60 per share. Dividend yield currently sitting at 2.81%, so not super high, but it is a little bit higher than the average S&P 500 company. Payout ratio sitting nice and low at about 30%, moving averages all down. Now, analysts have a target price of about $354 per share, so quite a bit higher than the current trading price, and the beta sitting right at 1, so we are going to see the volatility levels in the market reflected in this company. But let's go ahead and jump into our first valuation, and again, that's going to be Graham's valuation. I've already explained this one. Here's our formula for calculating intrinsic value. We can see they have a pretty high growth rate projected for this company, but again, that current yield on AAA corporate bonds is going to drive down this valuation. But despite that, we can see they still have an intrinsic value of $323 per share, still quite a bit higher than that current trading price, and that's due to that high growth rate projection and the really strong earnings per share for this company. Now, moving forward to the discounted cash flow model, we can see for the future free cash flows for this company, I projected a growth rate of 12%, and that's after doing some research into their industry and into their business model. So I projected that growth rate to the future free cash flows, found their present value, added those together, added the company's cash, and subtracted out their total debt to get their equity value. After dividing by the number of shares outstanding, we come to a discounted cash flow price per share of $415 per share. So this leads to a very high valuation for this company. Moving forward and looking at our multiples valuation, you can see what companies I used that I found fairly similar to Home Depot. So we take their stock price, divide by the earnings per share to find their price to earnings multiple. The average price to earnings multiple is about 19.72 for this company. We multiply that by Home Depot's earnings per share, and we come to an intrinsic value of $280 per share. Now, moving forward, we're looking at our last valuation, the dividend discount model. Again, I love to look at this valuation to see the dividend growth over time. If we jump back over to our stock screener again, dividend yield of about 2.81%, but let's look at that dividend growth for the company. We can see year over year, 32%. That is a huge year of dividend growth a few years ago, 10%, 10%, and 15.15%. So really good dividend growth again from this company. That's a year over year average growth rate of 16.87%. Moving forward, I'm applying a growth rate of 7% and a discount rate of 9%, leading to an intrinsic value using this valuation of $406 per share. Now, if we jump over to the output tab, we'll see all four of our valuations. Graham's at 323, multiples at 280, discounted cash flow at 415, and dividend discount model at 406. So all four of these valuation models are higher than the current trading price of this company, but when we average all four together, we come to an intrinsic value of $356 per share. Now, let's go ahead and apply our margin of safety. Let's say for this company, we want to apply a 20% margin of safety as an example. Based on that, our acceptable buy price is $285 per share, meaning now would be a good time to buy the companies. Out of all the companies that we look at today, I think this may be the one that's trading at the best value. They're on my watch list and I may add shares in the near future. They have great growth prospects for the future and great dividend growth historically. Now let's go ahead and look at our last company. And the last dividend stock that we're going to be looking at is Target, stock ticker TGT, currently trading at $152 per share. Now that's not quite at their 52-week low, but it is getting very, very close. We can see year to date, they're down about 34.2%. And right here, you can see a huge decline in their share price. And so why was that? Well, in their most recent earnings report, they reported that they had a large amount of unwanted inventory, which led to a huge sell-off in their share price, as we can see right here. Now, jumping into our stock valuation spreadsheet, you can see I've already plugged in the stock ticker. Coming over here and look at the dividend data, they're paying out $4.32 per share, which gives them a dividend yield of about 2.83%. Payout ratio currently sitting at about 40%, so I would like to see it a little bit lower, but it's still a good payout ratio overall. Obviously, 20 and 50, 200-day moving averages all down. Analysts currently have a target price of $191 per share, which is interesting because if we jump back over to our Seeking Alpha, we can see they were trading as high as almost $250 per share earlier this year. Now coming over here, they have a beta of 1.02, so not a lot of volatility, and institutional ownership is sitting at about 80.5%, so that's pretty high as well. Moving forward and looking at our first valuation, we're going to be looking at Graham's valuation. We'll zoom in and come over here a little bit, and we can see we're projecting a growth rate of about 14, decent earnings per share, but the current yield of AAA corporate bonds, again, sitting at 4.65, will drive this valuation down. But despite this, the intrinsic value at 175 is still higher than that current trading price at 152. One of the reasons that I do like this stock. Now moving forward, looking at the discounted cash flow model, I'm projecting a growth rate of 12% to the future free cash flows for this company after adding their cash and subtracting out their debt, getting their equity value, and dividing by the shares outstanding. We come to a discounted cash flow price per share of $283 per share. So this valuation led to a very strong intrinsic value for the company. Looking at the multiples valuation, I think this is a good way to value a company in their industry. We're taking companies like Walmart, Dollar General, and Kroger. Once we get their price to earnings multiple and the average, which we can see is sitting right at 20, we multiply by the earnings per share for Target and come to an intrinsic value of $179 per share. So what exactly does that mean? Well, if we look at the average price to earnings for this company at 20.3, jump over to our stock screener, we can see the price to earnings for Target is sitting just at 17.33, which may be a small indicator that they are undervalued. Jumping on to our last valuation, the dividend discount model, we can see right here they don't have quite as much dividend growth over time over the last few years, but if we look at their most recent dividend increase, it was a massive dividend increase at 32.35%. So that gives them an average growth rate of 10.43% year over year. Moving forward, I'm applying a growth rate of about 6.5%. It may be closer to that lower range at 3% here moving forward for the next couple of years, but I think that will start to jump up a little bit more over the next 5, 10 to 15 years. After applying a discount rate of 8.5, we come to a dividend discount model price per share of $191. So if we jump over to our output tab, we can see our four valuations, 175, 179, 283, and 191. And when we average all four together, we come to an intrinsic value of $207 per share. Now, if we apply a margin of safety of about 20%, we can see based off of that, our acceptable buy price is $165 per share, meaning now may be a good time to be buying a stock. So there you have it. Those are three quality dividend growth companies that are currently at 52-week lows. I currently have all of these stocks on my watch list, and I actually do own a couple of them, which you can see in my monthly dividend portfolio updates. So that being said, if you guys would like to be able to download the spreadsheet, then you can head over to my Patreon page at the link in the description. And please don't forget to like and subscribe to the channel.